Thanks for joining me again today. It is January 25th, 2022, and I've been on a little bit of a hiatus, doing a lot of research on various things going on in the world. And I'm actually redoing part one of this series because I felt like the first one was a little bit long. So I'm going to start off by introducing the Vanguard group. Many of you obviously have heard of Vanguard. As you'll see here, this is the Wikipedia page. They have about 7 trillion in global assets under management. They're the largest provider of mutual funds and the second largest provider of ETFs in the world after BlackRock. And so I wanted to bring that up is the backdrop for what I'm going to share. And I've got some tools that I just got to move out of the way and kind of move around a little bit. So let's see if I can get this one out of the way. Okay. No, that's not going to do it. So let's see if I can pop it there. Now, I want to first talk about an article that Vanguard put up on their website in July of last year. And it talked about this 4% rule. And I'm going to go over this article. I'm also listing it in the comments section, so you'll be able to see it. But fueling the fire is called Financial Independence Retire Early. It's a community of folks, and you might be one of them that's looked into, getting financial independence, mostly through the stock market, investing, and then retiring early. So early would be, say mid 60s. And so many people are trying to retire, in their 40s, right? So they have a longer, what they call retirement horizon, which means how many years you'll be in retirement. Of course, if people are living on average into their, 80s now, well, maybe a 40-year-old that's probably going to live into their 90s. So if they retire in their 40s, there's a very good chance they'll have somewhere in the range of a 50-year retirement horizon. And so let me just, start by trying to give you some lay of the land of what this 4% rule is. Now, this gentleman, William Bengen, in 1994, came up with this 30-year time horizon, 30 years of retirement, and how much could you spend in your portfolio in the first year and then follow it on by inflation-adjusted withdrawals in subsequent years and not run out of money. So saying you could draw out 4% every year, and as long as you were continuing to invest in the stock market, then you would not run out of money. Now, that's off of historical numbers. Now, again, here's the largest mutual fund company in the world, and they are actually forewarning people that maybe they're just a little bit too comfortable with this idea of the 4% rule. So they came up with this update to the 4% rule for those folks that were looking to retire in general, but also this, group called Financial Independence Retire Early, that community. So the 4% rule was tested using historical market performance data from 1926 to 1992. Okay. And they're assuming that that's how things will continue to go. But as they say here, that's a big assumption. Again, I'll link to this article. They came up with a simulation engine that forecasted future performance by analyzing historical data. And so they are now saying, well, this is what our historical averages were over that period of time, from January 26, 1926 to March 31st, 2021. You're talking about U.S. stocks, U.S. bonds, what the inflation rate was. Now, again, this is their numbers, doesn't mean it's the gospel, that type of thing, but this is what they're predicting. So, close to 10.5% returns over that period in the U.S. stocks, almost 5.5% on U.S. bonds. And what they're talking about is cutting that like in half or greater than half of the U.S. stocks, which is a huge difference. And, being like basically, a fourth of the kind of returns that you got in U.S. bonds. They're also talking about inflation being lower than it was from 26 to 2021, which, I don't know how they're coming up with that because, clearly most of us feel that we're much higher than that today, and even higher than the 2.87% that was over that 95-year period. So take that with a grain of salt, right? But what they're saying is if you had a 30-year time horizon, that's where this 4% rule came in, and you're relatively safe historically, that if you took out only 4% of your portfolio for your living expenses, for your lifestyle, you wouldn't run out of money. But if you switched it to a 50-year horizon, right? It's not just people that are trying to be financially independent and retire early. We don't even know what early really is, right? We don't know that, 67 won't be early, right? That somehow you'll live to be, in that case, 50 years should be 117. Who knows that we're not going to live that long, right? And so that might be early too, right? So what they said was that 4% rule gives a 30-year retirement horizon about an 82% chance of success. So it's not even 100% with this 4% over 30 years. But if you're having a 50-year retirement horizon, you only have a 36% chance. But go down to number 3 here, and they say that, well, in that 4% rule that was created for that 30-year horizon, they did not factor in investment fees, which is the commissions of trading in and out of stocks within a mutual fund or individual stocks, just as a portfolio. And then there's, an expense that, the people that are advising you, the brokerage house, they're taking a percentage. So they said if it was only a 0.2% expense ratio, right, on these fees, that 36% on a 50-year horizon would drop to 28%. If it was a 1% expense ratio, which is very common, they estimate it drops to 9%. So there you go. You really don't know what's going to happen, right? And a lot of people don't even know, what their expenses are in these portfolios that are made up of stocks and bonds. So I just wanted to kind of give a lay of the land on that. You'll be able to go and check that out. Now, I'm going to bounce to this other article, and it's what percentage of people, max out or put in the most amount of money they can into their 401k. Now, I'm focusing on 401ks because that's where most people consider, that they're saving for their retirement. And I put saving in quotations, right? Because really, it's not a place that you would, protect it. Save it means pretty low risk. Putting it in the market means you could lose it all. Of course, you can have positive returns, and many people do, but many people do lose all of it. So that's called risk. And that's speculation because you're taking a chance, right? You're speculating that it's going to work out in your favor. But I wanted to show you some numbers, which I think will be, somewhat eye-opening, right? Is what is the percentage of people that are eligible to put money into a qualified plan like a 401k at a company that they work for? Now, I'm not going to get into all the matches and all that, but what they say is 13% of eligible participants put in the maximum amount that you can put in. And that was a study that was done in 2017 when the limit was 18,000. Again, we're not talking about matches. We're not talking about, whether, people can even do this income wise, what percentage of your income you can put in and all that, but only 13%. So basically, close to, 7.5, 1 out of 7.5 people even max out what they can put in. And they did the same thing. They looked at the numbers in 2020, and it's still, 1 in 7.5 people were maxing out, right? So I wanted to talk about the fact that in 2022, this year, the maximum you can put in if you're under 50 years old is 20,500. I'm not talking about what they match, all that. I'm going to do a comparison eventually with another option. And I wanted to say that, that is going to be surprising. You're going to see that most people, even if they put in the maximum amount, it's still probably not going to be enough income, 30 years out. If they started, say, at 30 or 35 years old and they retired at 60, 65 years old, you'll see what you can, what your chances are of success. And 20,500 is not going to be enough. They do allow you right now to put in some additional money if you're 50 and older. It's like a catch-up kind of thing. But of course, this other option I'll show you, you're not capped at what you can put in. There's other qualifications that you need to meet, but that is what I wanted to share. And I did want to quickly, again, show something that Vanguard has created. They've created this retirement nest egg calculator. And they say how many years should your savings last, or your assets, your money in retirement. So when you retire, I need it to last me, from 65 to 95. You get to play around with this and see what that percentage is. So by default, this is what you get, and I'll show it in the next video too. They allocated, just like the 4% rule that William Bengen created. It was 50% stocks, I believe 30% bonds, and 20% cash. Now, you may not put it in cash, but the idea is that you're supposed to have some emergency funds, and also you have some of your money in cash because you've got expenses, so to speak. So this was the setup by default with this website. And when you run the simulation to see if, let me try to get this. Okay, so we're going to run simulation, and we'll see what the percentage chance is that over 30 years that $1 million is going to be enough. And it comes to 83%. So pretty much what that story that I showed you was saying was that, you don't even have 100% chance that this is going to last. And I'm going to leave it at that. And then we're going to come back to part 2. And I'm going to do the comparison with another option besides comparing it to putting in the maximum amount into your 401k, and then what it would look like if you put it into another option. All right, thanks.